Corporate finance presentation. Payback period. Get ready. It's time to take your chance with corporate finance. Payback period. Sounds intense, but really it's a fairly basic calculation, but it's fun to say. It's payback time, payback period. Sometimes it's referred to as the payback method. Now remember, what we're talking about here are capital type investments, those types of investments that will typically have cash flows more than a year out into the future. The typical scenario being that we're putting money down up front in order to get something that's going to help us to generate money into the future. And usually that could be something like a project we're investing into. We might be putting money into equipment. We might be putting money into inventory, for example, and we expect to get future cash flows from that investment. So the idea of the payback period is just what it sounds like. The idea in question would be, if I'm putting this money down, when am I going to get the money back? I would like to at least know when I recover the money. It's kind of a knee-jerk reaction that you might have when you're putting money down or if someone's asking you for a loan or something like that. The first thing you think about before you think about interest or anything else is like, well, when am I going to actually get the money back? I'm not even thinking about time value of money, inflation, or anything like that. Just when am I going to get like my actual money back? How long will that take? And then, you're going to think about, of course, the other types of things, which would be how much are we going to generate from this? What's the time value of money? And so on and so forth. So this is one of our more basic type of calculations here. Doesn't take into account the time value of money, but still a good calculation. And again, it's one of those first things that are probably coming to mind when you think about a long-term investment, putting money down, say today, for revenue that you hope to get in the future. So it's going to be the time needed to get back the initial investment. So for example, the best way to look at this is just with an example. We have the investment of the $220,000. We imagine the cash flows are going to be in the future for the next 4 years. So this initial investment, once again, could be in something like equipment. It could be in something like a project, could be in inventory or something like that. Things that we are going to put money down on now because we expect to receive a future cash flow. The future cash flows for year 1 through 4 being $70,000 year 1, $40,000 year 2, $60,000 year 3, $70,000 in year 4. Now, when am I going to get that $220 back? The easiest way to do this is just to set up a table looking like this. You can do this by hand if you're working on a test question. We do have multiple examples that we will work in Excel and in presentations in OneNote. Highly recommend just going through multiple examples. Even if you think it looks kind of basic, it still takes a time to just set up the table properly. So you want to make sure that you can basically do this automatically. So we're going to have the initial investment, which would be the $220, and then we'll just list out our years and see when we're going to get paid back. So the first year we're going to get back $70,000. So if we put down then 220,000 minus the 70,000, that means that we're going to get 150 after the first year that still has not yet got paid back. So we're going to say, it's not in year 1. Are we going to get paid back in year 2? Well, we're going to get 40,000 in year 2. So if I take that 150 minus 40,000 in year 2, nope, we still got 110 that hasn't been paid back. Is it going to be paid back in year 3? Well, we get 60,000 in year 3, so minus the 60,000 in year 3, we still have 50,000 yet that hasn't got paid back. Are we going to get it paid back finally in the last year? I hope, because that's like the last year that we expect revenue generation based on this. So we are minus the 70,000. We're going to get paid back in sometime between year 3 and year 4. And this also, by the way, gives us the profit calculation when you do this running balance. Also note, this running balance is really useful to do in Excel because it's a little bit complicated to get down, but once you have the running balance down, it's very applicable to many different things, and you can use basically an autofill to do that. So we do practice this in Excel. If you expect to see this problem in a book problem, then of course you want to be able to just draw the chart simply just like this and do your calculations. Now note that if you do a running balance, it will of course give you the net cash flows, which you could get simply by looking at the cash flows. This would probably be the first thing that you do when you do this calculation. You're saying, well, the inflows for the next 4 years are 70,000 plus 40,000 plus 60,000 plus 70,000. That's going to be 240,000 minus the 220,000. That means over the 4-year time period, not taking into account time value of money, we're going to get a $20,000 profit. Now that's good, but doesn't help you a whole lot because it doesn't take into consideration time value of money, and it's hard to compare to other projects that are not of the same kind of, the same type of investments, or possibly the same type of inflows, or the same time period that will be covered. So that's probably the first thing we would do. Second thing we would do is say, okay, well, when am I going to get the 220 back? That's the payback period. So it happens between 3 and 4. Note that although it gives you the 20,000 at the end here, and that's probably the first and easiest calculation you would do, if you get a test question asking technically, does the payback period tell you what the net profit will be, not considering time value of money even, the answer is no, because the payback period just tells us when you got paid back. Anything beyond the payback period is beyond what the payback is. The idea of the payback period is, okay, I get to this point in time, I got my money back. Everything from there on is basically revenue. So it kind of gives you that feel-good feeling. You're like, okay, I got past the point where my money's gotten back, and everything that I get from this point forward is kind of like revenue at that point. So technically, it doesn't give you basically the gross profit even without time value of money, even though in practice you probably would. So if you'd probably calculate that first. So if you get a test question about that, just keep that in mind. Then you're going to say, well, what's the time frame between 3 and 4? This is often the area where people that are taking a test question have problems with, because it's that fraction of a year that can be a little bit confusing. So we can do that this way. We can say, well, if we've got the 50,000 and then 70,000 that's going to be received in the next period. So we're going to take the 50,000, the amount that we need to break even to get paid back, divided by how much we're going to get in year 4. We're assuming that we're going to get paid evenly throughout the year. So we'll divide by the 70, divide by 70,000. We get the about 71, the 0.71. So we're talking 3.71 years. Also note that 0.71 could be represented in a test question multiple different ways. They might represent it in days, for example. So that would be, I'm going to say 12 times 30, which would be 360 days. 365 is closer to a year, but if you have a nice even year, 12 times 30, 12 months times 30 days, 360 days times the 0.71 would give you about 255.6 days. So 3 years, 255 days. You could take that and divide it by 30, imagining 30 days on average in a month, to get 8.52 months, to kind of figure out 3 years and 8.52 months. Or to get to the months, you can take then the 12 months times the 0.71 to get that 8.52. So we'll do many of these calculations as well. Again, you want to get comfortable with these and be able to lay them out in a table easily, either in Excel or in your worksheet, depending on what your use is for them. So we have the payback period. The pros are going to be it's simple to calculate. Remember that the payback period is kind of like that knee-jerk reaction. You're going to say, what's the total revenue that I could get, not taking into consideration time value of money? That's easy to calculate. And then when am I going to get my money back? So that's going to be, the basic kind of two things that probably run into your mind as soon as you think about putting money down. And then the liquidity is emphasized. So it's going to emphasize basically liquidity, which again could be useful depending especially on the industry and the liquidity of the organization. The cons, of course, the primary con, the time value of money is not taken into consideration. So if we're talking about projects that are going out multiple years into the future, we should be considering time value of money. If we do not look at the time value of money, then we're not taking into consideration the full costs that are going to be there, and it's going to be more difficult to compare to other projects, especially other projects that are different in nature. Remember, when we're talking about these long-term projects, if I was to compare it to another project, it might not have the same amount of initial investment. It might not have the same amount of flows that come back, or even the same periods. The other project might be much longer in terms. How do I compare projects that are uneven? Well, you could think about when you get paid back on both of them, but that's a limited kind of calculation, because you're going to want to know more about that projects in order to make a decision between the two if you're deciding between them. Does not include cash flows after the payback. So again, you probably would calculate, like we say, the cash flow after the payback. You'd probably calculate what your net income would be, or continue this running balance and see what the revenue basically would be, inflows over the outflows in total. However, technically for the payback, it only tells you how much you get or when you get paid back. It's not really designed to go beyond that point in time. Again, although you probably would do so, even though it would not be in a time value of money kind of framework. So the fact that it's not really taking into consideration really the revenue, it's really just getting to that knee-jerk reaction of when do I get my money back type of situation. When can I feel good that after that point in time, it's all revenue after that point in time. So these are the limitations that typically will be emphasized with the payback period as we then take a look at the ones that do take into account the time value of money. That's going to be the net present value and the internal rate of return. So remember, for book problems, the payback period, although very useful, and although it's probably the first kind of couple calculations you do when you think about these long-term projects, it's going to be emphasized in the book problems in terms of its limitations so that it can compare and contrast the payback period versus the other two, which are going to be the robust type of calculations, the net present value and internal rate of return, because those do take into consideration the time value of money, and therefore, when you really get down to it, those are the ones that you want to take into account when looking at these long-term projects. You really want to look at those because these long-term projects are those types of things that are going to affect multiple time periods. They're difficult to reverse, so you want to make sure you're taking into account all the factors and measuring the pros and cons of different projects in the most accurate way that you can, and that would typically mean taking into consideration time value of money.